So here we go with our next question. Is there any way to reduce the burden of taxes for inherited IRAs except converting to a Roth? I've just about decided to start reducing it yearly and paying the taxes myself, but I was wondering if there was anything else I could do. I would like to know what kind of an immediate annuity that you have, since that would be one way. I know I could not pass anything to the heirs that way, but it is one option I am interested in. Jerry, thanks very much. And there is definitely a problem with the inherited IRA from a tax perspective that did not exist just 3 short years ago.
Yeah, the Secure Act, which we have railed against on this show on a number of occasions, is anything but secure as far as our clients are concerned, because it's really jeopardizing the future security of particularly of those folks that inherit IRAs. Now, how can that be a bad thing? Yeah. Well, just think about this. If you inherited a $100,000 IRA and you took all that money at once, then all of a sudden you've got $100,000 more in income and you're thrust into a bigger tax bracket. Now, that's the extreme. But that $100,000 IRA has to be divided up, and you have to take it out all within a 10-year period of time. And so there is complexity to this, and it really does, as Jerry has alluded to, really create a tax burden for folks that maybe are in their highest income earning years, because if you think about when a parent dies and leaves it to a child, this is where the rub comes in. That child is in high earning years, then all of a sudden they've got all this other income that is being forced for them to take, because they have to take it over a 10-year period of time. So we warned everybody about this back in 2020, Scott, when the legislation was passed, that it was going to create this tremendous tax burden. And we're seeing evidence of this show up in Jerry's question. This applies to 401k plans, traditional IRAs, even applies to Roth IRAs, although the Roth is not taxable. Right. You still have to take the distribution. But unfortunately, Jerry, there's not much that you can do to relieve or reduce the tax burden. Of course, you could have taxes withheld from the distribution, and therefore the IRA or 401k plan is paying the taxes itself, but it may cause you to pay a higher tax bracket in your own personal income. So the real problem arises when those distributions are significant and are added to your normal taxable income, Scott.
Yeah, and the other problem is if you send it to your heirs, if there's only one heir and it's a substantial amount in the IRA, right? Because this really isn't, if you've got $400,000 or $500,000 and you've got 4 or 5 kids, it's probably not going to be that big of a deal.
Right.
But if you've got one kid and you've got $1 million, that's where he's really going to be stuck. So how do you deal with that?
Well, let's take a look at a graphic that we've got here. And if you are listening to us on podcast, you can go to our website at Get Ready for the Future. I'm sorry, our Facebook page at GenWealth Financial Advisors and see this graphic. You've got, if you have an IRA that you've inherited and you are a non-spouse beneficiary, meaning that you're not the spouse of the person who passed away, and it happened in 2020 or later, you have the option to withdraw the entire amount in a lump sum, which is probably not a tax efficient thing for you to do. Or you have option 2. Option 2 is kind of twofold. If the original owner had not started taking required minimum distributions, you can deplete the account over 10 years. If the owner had started taking RMDs, you have to take annual distributions based on life expectancy in years 1 through 9, and then deplete the balance in the account in year 10. Well, year 10 could be a problem for you. Yeah. If you take it on life expectancy and it's not that much, but it's a big amount, then all of a sudden in year 10, you have to take all of that money out. I don't think that Congress really was mindful of how this was going to impact people. I think they saw it as an opportunity to draw money into the Treasury ahead of time, as opposed to the old stretch IRA rules. And I think that's what's happened. Now, let's be clear. Jerry didn't ask about this, but let's go ahead and cover a second graphic that we have here, that if you're a spouse, if you are a spouse and you have inherited your spouse's IRA, they've passed away and you've inherited this IRA, you have the option, again, of taking it all in one lump sum, or rolling the funds into your own IRA. Or option 3 is to retitle the account as an inherited IRA and withdraw funds as needed without penalty if you're under 59 and a half. If you're after age 59 and a half, you can roll the inherited IRA into your own IRA. So Congress has made this anything but easy. They've made it anything but less burdensome to people. It is a big deal to people whose parents are passing away with some wealth and they're passing it on in the form of an IRA account. You need to work with a financial advisor to work through this.
So let's deal with the tax burden part of Jerry's question, John, because you mentioned it at the very front. Unfortunately, there's not a lot you can do here, and you cannot avoid the taxes at all. So if you hear people touting that out there from a sales perspective, from a financial advisor perspective, it's disingenuous at best. You cannot avoid it. You can minimize it. So working with a financial advisor to determine how you can make some withdrawals during your lifetime that don't put you in to a higher tax bracket allows you to receive the funds, pay a tax amount that is likely less than your heir will pay when they were to receive it, and you don't have to spend the money. You can reinvest the funds and put them in a non-qualified account, which will receive a step up in cost basis if you don't sell anything upon your death, and that would be a way for your heir to not pay very much at all on taxes.
Jerry also asked a question about an immediate annuity. I want to talk a little bit about this because there are folks out there that will, try to buffalo you into thinking that buying an annuity solves all this problem. Here's what buying an annuity does. It puts it on autopilot. The only annuity that works in this situation is a 10-year period certain immediate annuity. And you have to put the money into that 10-year period certain immediate annuity when you receive it as your inheritance and then start those distributions. If not, then you're going to be off schedule as far as the 10-year time frame is concerned. But the 10-year period certain immediate annuity just puts it on autopilot. It distributes basically a tenth of the money plus whatever interest rate that fixed annuity is paying you. It pays out on an annual basis. It could pay on a monthly basis, but it does automate it. But there's no magic. It doesn't reduce the taxes or anything of that nature. It simply is an automated vehicle to make sure you don't screw this thing up and impose even more penalties on top of you in addition to the tax burden that you've already got.
And a couple other things you could think about here is a qualified charitable distribution. You wouldn't actually be able to spend the money that you're taking out of your IRA, but you cannot pay tax on that money. So if you're a charitable thinker, charitable minded, you're already giving to a church, let's say, and right now you're using after-tax money to do that, you could begin sending your church qualified charitable distributions from your IRA. Those are non-taxable if they are sent to a qualifying charity and directly to the charity. So again, you don't get to touch the money, but you're not paying taxes. That can be a way to reduce that. And then one thing, too, that people look at, too, now more than ever, John, is life insurance.
Yes, life insurance is a tax-free inheritance. And so oftentimes, if you are, this all has to be planned before somebody passes away, obviously. Right. But if you think about the fact that maybe you've got this significant amount of money in a qualified plan and you want to leave it to your family in the most tax efficient way possible, you might take part of that money that is in the IRA and use that money, a distribution from that IRA, to pay for a life insurance policy. Because at your death, then the insurance company is going to write a check to your heirs. There is no tax. There's no inheritance tax. There's no income tax, no nothing. They just get a check. And so that is really, with the Secure Act, that has really pushed life insurance into the forefront of being a great way to transfer assets to your family, allowing you to spend the IRA money knowing that you've got that life insurance as a backup for your legacy.
Just got to make sure that you're insurable. I think sometimes if you wait too late in life to do that, it's going to be very problematic to obviously accomplish that.